Hello and welcome to Abstract America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Abstract America. With me, I have Victor, who is also a senior consultant for Abstract America. Now, today we will walk you through the General Ledger, Lesson 1, and Victor will take us through. Victor, can you please take over?
Hello everyone, this is Victor as Bob introduced me. Today we are going to look at lesson 1 of our EBS Financials Functional Training. And these are the concepts that we are going to look at. First, we are going to look at what a ledger is. We are going to look at this as it pertains to Oracle Financials and also in the accounting sense. We are also going to look at the purpose of a ledger. Next, we are going to take a look at the features or properties of a ledger, and finally, we are going to go into the Oracle instance and create our own ledger. Okay. So, what is a ledger? A ledger is an aggregation or summary of accounting information that comes from the business events or transactions that a company takes part in. So, to understand the meaning of a ledger, let's first look at what are business events or transactions. The best way to understand this is maybe to give some examples. A business event could be when a company purchases goods or services. A business event could be when a company receives an invoice from a vendor who sold items to them. A business event could also be when a company disposes of assets that it has. So these are examples of business events, and these business events generate accounting information. And what do we mean when we say accounting information? So accounting information is I would say the monetary part of the business event. So when a company let's say sells goods or services, it sells them for some amount of money, and there is an account that is affected in the company. So for example, if one company purchases furniture, that company might have a furniture account that reflects all the activities that pertain to it purchasing or disposing of furniture, and this company might pay for this furniture using cash, or it might promise to pay later, and in this case a cash account might be affected, or an account that shows a promise to pay, that is a payable account, might be affected. So this is the meaning of a business event and the accounting information that these transactions generate. So how are these business events recorded and posted in a ledger? Business events are recorded or captured through journals, and the meaning of a journal is it's a detailed description of a business transaction, and some of the information that may be captured in a journal may include the date, amount, and the purpose of this journal. In fact, a journal is referred to as the original book of entry, because this is where, when the business transaction first takes place, this is where the first recording of this event is done. It is done using a journal. So, before the accounting information from a journal is transferred to a ledger, it has to be posted. This means that a business event or transaction can be captured without being reflected in the ledger if it is not posted. A journal can be deleted if that journal was recorded wrongly, or if that journal is not correct in any way. So this is the relationship between a journal and a ledger. Okay, let's move on. All right, so on this slide, I would like us to talk about the relationship again between the journals and a ledger. And before we look at whatever is being shown on the slide, I would like to further explain how a journal and a ledger are related using an example. The best way I like to think about this is is using a personal diary. For example, when you're writing your own diary, you do it in days. So you might go and say a couple of things might happen to you during the day. So for example, you went and visited your friend, or you went somewhere and you had a bad meal, or you went somewhere and somebody did something good or something bad to you, and you write all those events that happened to you under a certain date. So let's say 1st of January. This is what happened to me. So those different incidences, you can think of them as journals. And then once you record all of them under that day, you can think of your diary now as the ledger. So when I go and read your journal entries for that day, I will be able to know, oh, so and so had a good day or a bad day. That is the same way that a journal and a ledger relate. So different business transactions will take place during a certain day, and by looking at and those events will affect the ledger in different ways, but in the ledger it is recorded in a summary form. It affects the overall balances of the different accounts, which we're going to talk about. Okay, so now let's look at this page. On this part, give me 1 second. So on this part, we have the first journal that records a business event that took place on the 1st of January. So this event, the company purchased furniture worth 1,000 shillings, and it paid cash. So this is the journal, and it tells us exactly what business event took place, the date it took place, and the amount involved. When this journal is posted, how does it affect the ledger balances? When we look at this end, we will see that here there is a credit entry for cash, that's 1,000, and we'll also see that there's a debit entry for 1,000 for the furniture account. The second journal took place, was recorded on the 2nd of January, and this business event affected the accounts payable account and the cash account. So this company cleared debts worth 500 shillings by paying the people that it owed the money. So that is the journal. And how did it affect the ledger or account balances? When we look at this end, we will see that we have a debit of 500 under the accounts payable account, and we also have a credit of 500 under the cash account. We also have another journal on the 5th of January. For this account, perhaps this company sold a product or some services worth 500 shillings, so it made 500 shillings or dollars in revenue. And then the person who they sold these services or products to gave them 250 in cash, and then they promised to pay them the rest of the 250, which went under accounts receivable. When we look at this side at the ledger accounts, we will see that we have a debit of 250, and we also have a debit of 250 in cash under the cash account, and we have a credit of $500 under the revenue credit. So this is the relationship between journals and ledgers. And just to emphasize, and we are going to look at this once we start doing this in the Oracle instance. In order for this accounting information to be transferred from journals to ledgers, posting has to take place. So you can record these business events or transactions and save the journals, but if you do not post the journals, then the account balances in the ledger will not be affected. All right, and then as you should know, these accounts belong to under the 5 types of accounts that are captured in the general ledger, which are assets, liabilities, revenues, expense, and retained earnings. So cash is an asset account, furniture is an asset account, receivable is an asset account also, payables is a liability because this is something you owe. You owe suppliers or somebody who you bought something from. And revenue is, of course, a revenue account. And these accounts can be of different types, let me put it this way, the 5 accounts can have what we can say sub-accounts that are under them. So you can have revenue of different kinds. Perhaps you sell different products. You can have, if you sell computers, you can have computer revenue. If you sell TVs, you can have TV revenue, and so on and so on. Okay, let's move on. So what is the purpose of a ledger? A ledger is used to show the financial position of a business or enterprise for shareholders, government, and other entities, other interested parties, such as investors. And, how do we do this using a ledger? We generate financial reports using the accounting information that is stored in the ledger. Examples of financial reports include the income statement, the balance sheet statement, and the cash flow statement. So the main purpose of a ledger, the reason why all the accounting information is stored in the ledger, is so that we are able to run reports from this information, and this helps in running of the enterprise or the business. Apart from this financial reports, which can be run periodically, we can also have other reports that are run intermediately, so that you can track all the transactions or all the financial activities of the company. And we are going to look at all those kinds of reports as we move on. Now, let's look at types of ledgers. And as we look at types of ledgers, perhaps let me say in the accounting sense, we should know that these types of ledgers also represent the types of modules in Oracle financials. So number 1, which we already know, is the general ledger. And the general ledger, as we have said, it stores all the accounting information from the business events, all the business events that a company or an enterprise takes part in. And this information is used to run financial reports. Now, apart from the general ledger, an enterprise or a company can have other ledgers that help it to manage other kinds of financial information. So, a company might have a sales ledger, and what does a sales ledger do? A sales ledger helps the company to manage customers and to manage sales information. And it also produces accounting information from these activities that is sent to the general ledger. So the sales ledger, in the accounting sense, is the account receivable module in Oracle Financials. So basically, accounts receivables in a module in Oracle Financials is the sales ledger, because it helps to manage information about customers and the things such as sales invoices and all the activities that pertain to the what do we call order to pay cycle of business. Now we have the purchases ledger, and what does the purchase ledger do? It manages suppliers. It manages suppliers and or vendors in all the information that pertains to this cycle of the business, such as purchase invoices. And it also produces accounting information pertaining to these activities and sends it to the general ledger. The fixed asset module, which can also be considered, which is also a subsidiary ledger in Oracle Financial, it manages information pertaining to the company's assets. What are assets? These are things that help a company to conduct business and generate revenue. Assets can include things like land. They can include things like vehicles that the company uses to run the business, machinery, or depending on the kind of business that the company is involved in. So the fixed asset module, it manages this information related to assets and produces accounting information from those activities. So from those assets. So accounting information from fixed assets might include transactions that show depreciation or writing off of assets. And then we also have the cash management module. This module, most of the time, it works hand in hand with the account receivables and account payables to manage bank accounts and reconciliation. So this is it does things like cash clearing. When you write a check to somebody, before it clears, this clearing activity is managed by the cash management module. Okay, so those are the types of ledgers, and these 4 ledgers are considered subsidiary ledgers because they support the general ledger. In fact, it is possible for a company to have just one ledger, the general ledger, depending on, let's say, the size of the company or the number of business events or transactions that the company is involved in. If it's not a big company and it doesn't have a lot of information to be managed, then you can enter all the information, you can capture all the journals directly and enter them into the general ledger because you don't have a lot of information, maybe like customers or vendors that you need to manage, or you don't have many fixed assets that you want to manage. So this is why these are called subsidiary ledgers, and this is the main ledger where all the accounting information is managed from. So this slide represents information flow from the subsidiary ledgers to the main module, which is general ledger. And as we said, accounting information is sent and then imported into the general ledger. And this information is used to generate financial reports. And we can see here that we also have an option to enter journals directly into the general ledger. This is another representation of the flow of information. So we create journals, we enter them into sub-ledgers, and then the journals are imported into the general ledger, and the accounting information is posted, and it affects the account balances in the general ledger, and this information is used to produce financial reports. We also have another path where we can enter journals directly into the general ledger, and we can produce financial information using the accounting that is produced from those journals to generate financial reports. So we have already discussed that the information that is captured in a ledger is accounting information. In order to capture this accounting information, there are things that we need to create or to maintain that enables this process of capturing and using accounting information. So in order to do this, what do we need to create, or what do we need to have? We need to have something that enables us to capture the dates of transactions. And this feature is a calendar. We need to create an accounting calendar in general ledger. We need to create and maintain something that enables us to see the accounts which are impacted when business transactions or events take place. And companies can take part in different kinds of activities or business events. They have different types of businesses. And this feature that enables us to do this is the chart of accounts. We also need to see the monetary amounts that are involved in these business events and transactions. And what enables us to do this, it is a functional currency. So these are the things that we need to have in order to capture accounting information in general ledger, which we are then going to use to produce reports. So we are going to look at each of these things, the calendar, chart of accounts, and functional currency, how to create them, and how they impact how we use the general ledger module. So let's move to the first feature, creating an accounting calendar. So the accounting calendar will help us to capture journals in a chronological order, and it will help us to generate reports in general ledger through periods, through cycles of time. So in order to create an accounting calendar, what do we need to do? First, we need to choose a financial year type. We have two types of financial years. One is a calendar year and the other is a fiscal year. A calendar year runs the same way that we read a calendar from January to December, so that's simple enough. A fiscal year is described as any period of 12 months which does not end on December 31st. So a fiscal year can be from, as I've indicated here, from April to March. So let's say April 2017 to March 2018. That's a fiscal year. It can be from November 2017 to October 2018. That's another fiscal year. So why do we have a fiscal year? It's because, I mean, businesses or companies are founded all through the year. So they'll start their reporting activities when they are founded. So if you start your company and it starts conducting business in April, you can't wait until January of the next year to start your conducting business so that you can and reporting these activities to the relevant authorities or to the interested parties. So this is why we have fiscal years. Okay, that's the first part. And then in order to create an accounting calendar, we need to select a period type. So companies do their reporting and they do the activities governed by periods. So one company might do the activities on a monthly basis. Another company might do the activities and report on a weekly basis. An example perhaps of an industry or a business that might do reporting on a daily basis is a bank, because banks do reconciliation every day at day end. So we need to select a period type that is relevant to the way we want to do our reporting and for the business. Under period types, we also need to discuss what are called adjusting periods. Adjusting periods are they're usually added to the end of your financial year, and the purpose of adjusting period is mainly for audit purposes. So adjusting periods overlap with the last period in your financial year. So let's say you have a financial year that runs from January 2017 to December 2017. You can have an adjusting period, which will be your 13th period, and this period can be a couple of days in the last week of December. So you can have an adjusting period that, let's say, from 21st December to 31st December. And this adjusting period is mainly for adjusting entries which help you to correct mistakes during the audit process. So that is the purpose of adjusting periods. So when you have a financial year with 12 periods, you can add an adjusting period at the end, and that will make it 13 periods. And we will see how we can do this in the system. Okay, so let's move on to the next thing that will enable us to capture accounting information. In order to capture accounting information, we said we need a chart of accounts. So what is a chart of accounts? A chart of accounts is basically a list of accounts that reflect the activities or the business transactions that a company expects to take part in. So here on this slide, we have two lists of accounts belonging to two different companies. You can see under company one, we have an account called cash. We have another one called furniture. We have computers, receivables, payables, retained earnings, and travel expenses. These accounts are also represented numerically: cash 1,000, furniture 1050, computers 1100, and so on. So if you look at this company, you may expect that some of the assets that it has are computers. Some of the assets that it has include furniture, and perhaps it pays for its employees to travel around, and this is something that it believes it needs to capture in journals and to record. When you look at company two's list of accounts, you will see it has cash, machinery, land, receivables, payables, and so on. And these companies are also represented numerically, but differently from company one. So here we have 100, 105, 110, and so on. So this company, you can tell maybe it has assets that include machinery. Perhaps it is a manufacturing firm. It also has land as an asset, and it also has an account that it uses to record maintenance expenses, maybe for the machinery that it owns. So these accounts, they basically represent what the company believes are the business transactions and the accounting information that it will need to capture. These accounts, again, to emphasize, are all under the 5 types of accounts that we have already mentioned: the assets, the liabilities, revenue, and expenses. So cash is an asset, furniture is an asset, computers, asset, receivables are also an asset, payables, the liability, retained earnings, just retained earnings, and travel expenses also are under the expense type of account. And the same applies to this company two list of accounts. So accounting information is captured against this account. So once you enter a transaction that uses cash, you are able to select this cash account to represent the accounting information from that event. And you can only select accounts that are listed from the list that are included in the list of accounts that for your company. Okay, let's continue with the chart of accounts. So, technically, in general ledger, you can create a chart of accounts that just shows this part of the account, because this is accounting information. You will be able to show that cash was affected, or fixed assets were affected, or receivables were affected, and the amounts. And we're going to talk about that next. But if you create a chart of accounts that just contains the account part, you won't be able to post these journals, and we're going to discuss why that is. So to create a chart of accounts, there are two mandatory segments, and this is these are technical terms now that we are introducing, the segments. The two mandatory segments are this account segment and the company segment. And these two segments are called, one, the company segment is put as a balancing segment, and the account segment is put as a natural account segment. So why is this called a balancing segment? As we know, when you enter journals, journals have two or more lines, and these lines represent debit and credit activity. Debit and credit activities have to balance, they have to equal. So for every debit, there has to be an equal credit. The Oracle system is able to tell that a journal is balanced using the balancing segment. So for every balancing segment entry debit that you enter, there has to be another journal line. So for every journal line in a journal that you enter that contains this balancing segment, there has to be another one to balance it. So for every credit, there has to be a debit. And if it's not clear, we are going to see this as we do the implementation on the system. So those are the two mandatory segments in a chart of accounts, the balancing segment, and the best practice is usually to have company as the balancing segment. You can have another company, you can have another segment labeled as your balancing segment, but best practice is usually company, so that journals are balanced by company. So the other segments of the chart of accounts are optional, and they are created to reflect what the company will want to display in reports, or what information it will want to show in reports. So if a company wants to run reports and do inquiries on those reports by service line, it will have to create a service line segment. This will enable it to track its events using the different service lines. For instance, if this company wants to know how much cash the operations people used during a period, then it will be able to do so only if it has this segment that lists the service lines. If the company wants to know how much expenses were used, perhaps by the salespeople, it will only be able to do that if it has a segment that the service line segment that enables it to do inquiries by those various service lines or departments, if we may call it that. So a chart of accounts is created to reflect the reporting needs of the company. Now in Oracle Financials, you can have as many as 30 segments, but as we said, the minimum is 2, which is usually the company and the natural account, which is the balancing segment and the natural account segment. Excuse me. Okay. So now, let's talk about the technical terms a bit. So this whole thing here, we can refer to it as the chart of accounts, because it contains all the natural accounts here, the cash, the fixed assets, the receivables. It has the balancing segments here, which which is usually the company. So we have one company, the Maskani developers, Maskani property. And by the way, these are the companies that we are going to use in the system as we do our own implementation. But this is a very redacted or truncated view of our chart of accounts. Ours is going to be a bit more complex with more segments. But this is just an example so that you can understand this concept. Okay. So, as I was saying, this whole diagram here, we can call it the chart of accounts. But to create the chart of accounts, we have to do it in a hierarchical manner or in a certain order. So first, we have to create a chart of account structure. What is a chart of account structure? Chart of account structure is this top part here. Technically, we can call it also the organization structure because it reflects how your business is organized. So our business is the Maskani group of companies. We have a company here. We have the accounts that reflect the activities that the company takes place in or participates in, and then we have other segments here that also reflect how the company is organized. So we have an operation service line, we have a human resource service line, we have a finance service line. We might also have other segments, and we are going to see as we do our own that reflect other kind of information. A company might want to have a segment that shows a geographical region. So maybe if it operates in different parts of the country, you might have provinces, you might have districts or something like that. Or depending on the type of company, you can have another segment that shows a different type of products. Maybe you can have depending, let's say, software or hardware and stuff like that. We can have another segment that shows projects, the different kind of projects that the company is working on. So the chart of account structure is also, we can basically also call it the organization structure because it shows how the company is organized. The chart of account structure is divided into segments. These are the segments: the company, the account, the service line. You might have other ones, as I have said, the project, the products, depending on the company. So the chart of account structure is divided into segments. Now, under the segments, we have a list. Under each segment, we have a list of values. Now, this list of values is called a value set. So under the account segment, we have a value set that contains account values. Under the company segment, we have a list that contains company values. Under the service line segment, we have a list that contains service line values. So this box over here, like that, is a value set. This is another value set, and this is another value set. And inside this value set, we have values. So those are the technical terms that we use or that are associated with the chart of accounts. And as we're going to see, when we are creating the chart of accounts, we do it in a step-by-step manner that involves those different features. So we create the chart of account structure, and then we define and qualify the segments, and then we create the value set, and then we put in the values in the value set, and then we qualify those values. Okay. So let's move on. And let's see how the chart of accounts affects the way we capture accounting information. So using this chart of account, we might be able to enter this journal at the bottom here. So this journal has a date, and we have already discussed this comes from having a calendar. And then this journal has an account. So this account part here, we are able to do this because we have created a chart of accounts. So let's dissect this part. We have this group of numbers, and this in Oracle jargon is called an account or an account combination. And now we're going to have to differentiate between what is an account and what is a natural account. So these values here are usually referred to as natural accounts. And we have already mentioned that this segment here is called the natural account segment. But this combination here is usually called an account or an account combination. And what comprises an account combination? An account combination reflects the different segments of the chart of accounts. So here, by looking at this journal, we can tell that company 001, which is Mascani Developers, acquired fixed assets 1100 right here, worth $1,000. Actually, it is Mascani Developers under the operations. This journal was entered under the operations service line, acquired fixed assets worth $1,000. How did it acquire these assets? It paid cash. How do we know? 001 1,000, which is the cash natural account, and it was paid through under the HR the HR service line. Now these other segments can be different, but as you see, the company segment, which is the balancing segment, has to be the same. So you cannot enter this journal and have this as a 002 because it will tell you that the journal is not balanced because the journal is balanced using the balancing segment. I mean, technically you can do it, but that is under an advanced topic which is called intercompany transactions, which we are also going to discuss as we move on with the training. But for now, understand that this segment in a journal, it has to be the same, the balancing segment. So that is how the chart of accounts affects the way that we capture accounting information. And another thing that we have learned from this slide is the difference between account and natural account. So this in Oracle financials is usually referred to as an account or an account combination, and these single values, let's say 1,000, 1,100, or cash fixed asset is referred to as a natural account. Let's go to the third thing that enables us to capture accounting information, and that is currency. Transactions will take place in monetary accounts. They have a monetary value attached to them. So in order to capture this, we need a currency. Now, unlike the other two features that we have already discussed, the calendar and the chart of accounts, we don't need to create currencies. Currencies come in preloaded. The term that we use is they are seeded in the system already. So what you need to do is just enable them so that you can use them for your specific implementation. We have different types of currencies. The first one is a functional currency. What is a functional currency? It is the local currency for the area of operation for your company. So this is the currency in which you're going to be capturing most of the business events or the transactions. So if your company is based in the US, that would be the US dollar. If it's based in Kenya, that would be the Kenya shilling. But then again, businesses are able to cross borders. So a business might interact with foreign entities. They might do business with other companies based in different countries. And for that, Oracle has enabled that. You can use a foreign currency. You can enter journals in a foreign currency. So Perhaps if you a business in Kenya does business with another one in the US, you can enter a journal in US dollars, but then the information is stored in the general ledger in the functional currency, and the foreign currency amounts are converted to the functional currency using exchange rates that are provided by users. Another kind of currency that we have is the stat currency, which in brackets you can see it just means it's the statistical currency. Sometimes companies want to track non-financial information that is important to them. So a company might want to track how many employees it has hired. So it will need a unit of measurement that helps us to do this. A company might want to say, if it is a construction company, it might want to see how many square feet of construction it has done. If it is a maybe logistics company, it might want to track the number of kilometers its trucks have traveled or things. Those are just examples. So stat currency enables us to capture this information, and as we proceed, we are going to see that we are able to enter stat journals, or we're able to enter mixed journals that contain both the normal currency, the financial currency, and the stat currency, which is the non-financial currency. All right, so let's take a look at what we have studied already. We have seen that to capture accounting information, we need a calendar, we need a chart of accounts, we need a currency. Another feature that is required in Oracle Financials is the sub-ledger accounting method. Sub-ledger accounting method is a bit different from the other things that we have studied, but I am going to explain it because it is something that we need to specify as we are creating our ledger, and that enables us to capture accounting information. So what is sub-ledger accounting method? We have two types of accounting methods: the cash and the accrual. How are these two accounting methods different from each other? Under the cash accounting method, transactions or business events are recorded or are captured in journals when cash is received or paid out. So if your company sells a product today, that transaction will only be captured if the other entity who you sold the product to gives you the cash on that day, on the same day. That might not happen. That person might pay you maybe 2 weeks after that. But under the cash accounting, this business event or transaction will only be recorded at that point 2 weeks later when the cash is actually received. And the same applies for expenses. You might acquire something, you might buy something that is needed, you might buy stationery from a stationery vendor and not pay them on the same day. That transaction will not be recorded when you acquire that stationery. It will only be recorded once you make the payment to the vendor, which can be 2 weeks or a month from when you actually acquired the stationery. Accrual accounting method is different in that the transaction is recorded when revenue is earned or when the expense is consumed. What does that mean? If I purchase stationery for my company from a stationery vendor, I will record that transaction then, even if I have not paid them. If I sell a service or a product from my company to a customer, I will record that transaction then, even if this customer has not paid me. So that is the difference between the cash and the accrual. They have their advantages or disadvantages. One maybe that you may already have noticed is under accrual, you might need to enter very many entries because you'll need to enter a journal for when maybe when you receive the stationery in our case, and then you need to enter the journal again when you make the payment to the vendor. So maybe that's one of the difference between the cash and the accounting and the accrual accounting methods. So when you are creating a ledger, because this is what we are trying to do with all these three features, you need to specify the accounting method, and you really don't need to create anything. Unlike the other three features, all you need to do is specify what accounting method you're going to be using, and the software will take care of that for you. Okay. So these four features that we have described are called the 4 C's of accounting. By looking at these letters that I have highlighted, you can see where the 4 C's terminology comes from. So we have calendar, chart of accounts, currency, and this one they try to be smart with it by saying highlight this C for the subledger accounting method to make the 4 C of accounting. So using the 4 C's of accounting, you can create your ledger. This might be a bit confusing because here I've said create primary ledger, but we are going to see that we have different kinds of ledgers. I mean, not the way we discussed as a general ledger, sales ledger, but you can in your general ledger module, you can create different types of ledgers. Primary ledger, you can have a reporting currency ledger, you can have a secondary ledger, but don't let that bother you at the moment. We are going to discuss that. But you can just remember it at this moment as with the 4 C's, you can create your ledger in the general ledger module. Okay. Now, at this point, there are some things that I would like to clarify. When you're implementing a general ledger module, you have to create at least one ledger so that you can use your GL module. So this means you can also create multiple ledgers in your GL module. Why would you create multiple ledgers? You might be managing financial information for different companies. And these companies, they can have similar features: the currency, the calendar, the chart of accounts, the subledger accounting methods, or they may also be different. So if you're implementing general ledger module for a client, you as the financial consultant, you can implement different ledgers, or if these companies use the same features, the calendar, the chart of accounts, and currency and subledger accounting method, you can also implement one ledger, and this information will be shared within that within that single ledger. Now, information in different ledgers cannot be seen. Once you log in as to view one ledger, you cannot see information that is captured in a different ledger, but you can see all the information that is within a single ledger. However, if a company implements a single ledger for different companies, if you implement a single ledger for different companies, if Oracle Financials also has features, security features that can enable you to hide data belonging to one company and hiding it from users who you do not want to see, maybe users that manage information from another company, even if this is in the same ledger.
Just to make a clarification, when you mean companies, I want the anyone who is watching this video to understand that Victor is talking about companies within an enterprise. Okay.
Yes. So, for example, we can say that the way we are going to implement our GL module, we are going to have a Mascani group of companies. This is, we can say, is the enterprise. And these are the companies under the enterprise. So we are going to have Mascani developers and Mascani property. So these two companies are under this enterprise of the Mascani group of companies. And we are going to implement this under one ledger. Thank you for the clarification. Okay. I think right now I am going to take a small break, and after that we are going to come back and start preparation for creating all these features in the system.